Welcome to The Explainer. Today, we're looking at a brand new investment category in India, one that's supposed to fill a huge gap for successful investors. Are these specialized investment funds the next big thing in wealth management? Or are they just a good idea on paper? Let's dive in and find out.
So, let's start with a question that I bet a lot of you have been asking yourselves. You've worked hard, you've built up some wealth, and you're ready for something more sophisticated than a standard mutual fund. But then you look at portfolio management services, or PMS, and that 50 lakh rupee entry fee. Well, it feels like a massive leap, right? So what do?
For the longest time, the Indian investment scene had this huge, obvious gap. On one side, you've got mutual funds, which are amazing and super accessible for everyone. On the other side, you've got these high-end PMS products for the ultra-rich. But what about that space in between? For high-net-worth individuals with, say, 10 to 50 lakh rupees to invest, successful doctors, entrepreneurs, senior professionals, there was really nothing for them. A real void.
Now, this gap wasn't just some small inconvenience. It was a massive hole in the market, leaving a whole group of smart, sophisticated investors pretty much underserved. And that's exactly where this story really gets interesting.
So, seeing this problem, the market regulator SEBI decided to step in. Around 2024-2025, they introduced a whole new framework, a solution built from the ground up, specifically to create a bridge for these investors and fill that missing middle.
Okay, so let's get into the good stuff. Specialized Investment Funds, or SIFs for short. This is the product that SEBI created to tackle that exact problem we were just talking about.
So what in the world is a SIF? Well, the best way to think about it is like a hybrid. It's got the professional management and the safety of SEBI regulation that you get with a mutual fund, but it's built for a savvier investor. It gives you access to more advanced, flexible strategies without needing the massive pile of cash that a PMS requires.
All right, the first key number you got to remember is this one, 10 lakh rupees. That's the minimum investment. Right away, this tells you that SIFs are for serious investors. It clearly separates them from the everyday retail mutual fund space.
And here's the second key number, 25%. Now what's this about? Well, this is basically their superpower. It's the maximum amount of the fund that can be used to bet against the market without a hedge. In plain English, it means these funds can not only try to make money when stocks go up, but they can also use clever strategies to make money when some go down or to protect your investment during a downturn.
And this is where you really see how SIFs try to give you the best of both worlds. They're regulated by SEBI and offered by the same big, trusted asset management companies you already know. But because it's a pooled fund, it unlocks those complex, long-short strategies that until now were pretty much out of reach for anyone who wasn't an ultra-high net worth investor.
Okay, so we've got this new player in the game. The obvious question now is, how does a SIF actually stack up against all the other options you already know about?
Let's put them head-to-head with mutual funds, because that's the comparison everyone makes. And whoa, the differences are huge. SIFs give you incredible flexibility with strategy, and it's a big but, they have low liquidity. You can't just pull your money out any day you want. Mutual funds are the opposite, super liquid, but the strategies are much more limited. And of course, that minimum investment, 10 lakh versus as little as 100 rupees. It's a different league.
And this table, it just lays it all out perfectly. You can see exactly where SIFs fit in. They slide right in between the retail world and the super high-end stuff. A 10 lakh minimum is way more accessible than 50 lakhs for a PMS or a full crore for an alternative investment fund. They are tailor-made for the HNI, while PMS is really for the ultra HNI, and AIFs often serve big institutions.
So, on paper, this all sounds amazing, right? The idea is strong, the structure makes sense, but now we got to get real and look at what's actually happening on the ground, because there's a pretty serious debate about whether SIFs are actually going to work out in practice.
And check out this quote. This comes from a paper by the National Institute of Securities Markets, an organization that SEBI itself established, and it really hits the nail on the head. There's a genuine worry here that SIFs could just become this great idea that nobody really puts to good use.
And here's the real kicker. This is the central problem. The whole point of a SIF is that it can use these fancy long-short strategies, but the rules only set a maximum for shorting, not a minimum. So what's to stop a fund from calling itself a long-short SIF, but then just running it like a regular old long-only fund? Nothing. And that would completely defeat the purpose. And hey, if you want a little preview of how this might play out, just look at their older cousins, the Alternative Investment Funds, or AIFs. Category 3 AIFs have been allowed to use shorting strategies for years. But look at the data. As of early 2024, they make up only 20% of all AIFs. That tells you there's a pretty low appetite among Indian fund managers for actually using these strategies, even when they have the green light.
The challenges here are pretty significant. First off, India just doesn't have a strong shorting culture. In a growing economy, it's a tough sell for managers to bet against companies. On top of that, a lot of the existing AIFs that could short are really just being used as a clever way to pool money and sidestep some of the PMS paperwork. And to top it all off, you need specially certified distributors to sell these complex products, and there just aren't that many of them around.
Okay, so we've laid out the good, the bad, and the kind of messy. After all that, what's the big takeaway for you, the investor? How in the world do you decide if a SIF makes sense for your own portfolio?
Let's be crystal clear. SIFs are absolutely not for everyone. They're built for a very specific type of person, a high net worth individual who has that 10 to 50 lakh chunk to invest. Maybe a successful professional like a doctor or an entrepreneur whose wealth is growing, or just a really informed investor who gets the risks and is actively looking for something more than what a mutual fund can offer.
But, and this is a huge but, you have to go in with your eyes wide open about the risks. With more flexibility comes more responsibility. You have to be okay with low liquidity. We're talking about only being able to get your money out once a month or maybe even once a quarter. You need to understand that these focused funds can have concentration risk. And get this, if your investment value happens to drop below that 10 lakh minimum, the rules could force you to sell your entire position.
So, in the end, we're left with this one big question. Are SIFs the brilliant bridge that finally connects that underserved investor in the middle to more sophisticated strategies, or are they a beautifully designed product that has arrived in a market that just isn't quite ready for it? I guess only time will tell.